Welcome to OmniTalk, powered by NXTsoft. I'm your host, Amy Rice, and OmniTalk is a podcast focusing on fintech and how it affects banks and credit unions. On today's episode, we will be talking to Rich Longo, president of the Omni vision for NXTsoft. Rich will explain the importance of strategy and what the future of fintech will look like for the financial industry. Today I have Rich Longo, the president of the Omni division for NXTsoft. How are you doing, Rich?
Good, Amy. How are you?
I'm good. I wanted to start this off with talking a little bit about your current position at NXTsoft and then also your experience within the financial industry.
Sure. So about 20 years in financial services or financial technology in the space, working with a variety of different players, from your more traditional players like FIS, which was previously Metavante, to disruptors in technology like Open Solutions, which is now owned by Fiserv. Worked on like the App Store, the original App Store back in 2009, to starting one of the first new core solutions about 2010, 2011, and then working for major foreign players like Temenos, working on their product strategy, and then Emphasis. And then I kind of went on my own and started advising to companies like Robinhood, and helping them trailblaze in the financial services side. And now I find myself here at NXTsoft with David Brassfield, who's the CEO. This is my third company with David. I'm currently responsible for the data business, which is Omni, and, leading our strategy overall, whether that covers product strategy or corporate strategy. So a lot of fun responsibilities.
Can you elaborate on why strategy is so important for a bank or financial institution?
Well, I think, strategy is more about thinking, right? If you think about chess moves, right? So if you're running a business or you're delivering value to clients and customers, you need to make sure when they invest with you, and you're delivering solutions or services, whether you're in the retail service, restaurant service, delivering burgers, or providing technology like what we are, that you're finding ways to increase the value or happiness of your end users, or your consumers. And consumers can be businesses, that you're constantly improving and changing. And if you think about technology, if you're improving and changing, it does take time to develop that. So it's looking at industry trends, it's looking at market behaviors, and so strategy is a super fun way to make sure a successful strategist it's a super fun way to make sure that you're consistently aligning to the future needs of your customers, and that your employees can see that vision and where you're leading, but more importantly, that you're executing successfully to adapt the organization to future needs.
Can you talk a little bit about the future of fintech and how that ultimately affects banks and credit unions?
Yeah, so if you look at financial technology, it used to be just contained to banks and credit unions and to firms that provided alternative lending, like payday lenders, let's say. But now you see other industry verticals, whether it's the transportation space, retail space, business consumers like Amazon, data companies like Google, all trying to get into banking or getting into transactions and payments. And so the lines have really evolved over the years from a fintech perspective, in which, it's put ever increasing pressure on traditional financial institutions to look at alternative ways to meet customer needs. And so I think continuously you'll see more pressure on how they price, how they deliver, and what they deliver over the next few years.
What advice would you give a bank or credit union regarding their strategy for the next 6 to 12 months?
I think it's really better understanding how your emerging wealth generation or the up and coming bankable individuals will want, right? So if you think about it a little bit, more of the generation that's coming out of college right now, they're not interested in buying houses. That's why you see a lot of complexes coming up where they're like mini cities. They have stores. They want to rent apartments. They don't want the responsibilities of maintenance. They want to be able to move around. They like increased amenities. Well, if you think about those sorts of things, what kind of services are financial institutions offering that are relevant? And so if you think about it a little bit, are they offering rental insurance? Are they offering, if I lose my job, to cover the rent, right? What products and services are they offering? They're not interested so much in debt. They're interested in savings, but they want creative savings. So, for example, a trend that we've seen is more of the Dave Ramsey effect, where they're going ahead and putting it in buckets, and they're saving to objectives and targets. And so are your institutions enabling your end users or customers to have that type of feature function where they feel it's relevant to how they bank? Are you communicating and advertising your products and services on solutions like TikTok? Or are you communicating through Snapchat? Those are relevant social media channels, not so much Facebook. So again, it's about how you're communicating to your client. It's about how you're delivering your products that are different to the adaptive needs of what your clients want today and how they're utilizing financial services.
What do you think about the fintech challengers coming into the marketplace, like Rakuten, Goldman Sachs by Marcus, and the low interest rates of 1.5% to 2% that they're able to offer? What does this mean for traditional financial institutions who are unable to compete with these low rates?
So, that's a great question. If you look at the industry, and you've seen a plethora of those challengers coming in, Goldman Sachs obviously is by Marcus is a huge one, where it's gotten a lot of traction. You've had institutions like Ally, which was GM's bank, GMAC, and their rates are highly competitive, and it is taking the deposits that financial institutions need. It is leading to an erosion of those deposits, which obviously has an impact on lending. You've seen articles from institutions like Co-America and Bank of America that they're restricted on how much they can lend now because of the erosion on deposits, and it's affecting their balance sheets. So the question is, how do you stay relevant? And a few institutions, like a perfect example out on the West Coast is Union Bank started PurePoint. And it basically was a challenger digital only bank. And so in essence, they knew they had to run different type of technology. They knew they had to have a different business model, which was less humans to reduce costs, but heightened digital services more so than and automation more so than what they had on the traditional bank. So it's running basically a parallel bank. And, it's a great way to kind of hedge your bets. So some institutions, banks and credit unions, don't want to give up that personal service. So you keep that business running in parallel to this digital services solution. And if your customers are looking for value similar to a Goldman Sachs, you give them that alternative with that financial institution without losing the customer. And because it's a bank within a bank and under one charter, you still have the ability to draw on those deposits and lend against it. So it provides the best of both worlds. And it also leads to the opportunity of, if that business really accelerates and grows, you can continuously build on innovation of that digital bank or challenger bank to your traditional bank. And then you can start winding down the traditional bank if you see declines in that business, and then see the growth offsetting into the digital bank. I think that's a super smart play, and I think you're going to see more of that coming out as institutions try to find their footing and continuously staying relevant in the new age of banking. And then, I think if you see the reactive approach too, outside of just traditional financial institutions and deposits, I love talking about the Robinhood story and what they did, which, this company started about 4 or 5 years ago, and they were the only institution and first trading firm to offer zero trading fees. And within 3 years, they ended up getting all of them, from TD Ameritrade to Fidelity. Everyone went and wiped away their fees. So there's no more trading fees, right? So the impact of those fintech disruptors also have a huge benefit to the consumers. But it also led to massive consolidation in, the trading world, where several of those companies had to merge with each other to survive. The threats are on multiple fronts, but you can't argue against the massive amount of disruption that's happening because of fintech. Robinhood was able to offer zero fees because they had a modern platform. They had very few humans running their solution. So, for example, up to last year, they only had 150 people, and they were servicing approximately 6 million customers. So compare that 3,500 people at E-Trade servicing 4 million clients. So there's an imbalance there, and obviously E-Trade was never in the position, because they had such huge overhead, to provide a no-fee type of trading fee solution. So again, it's imperative that, from a strategic standpoint, that these institutions can look at how they're going to address their business models, so they can stay relevant based on what consumers are expecting.
Well, thank you, Rich, for taking the time out of your busy day to share your insight on strategy with us. We appreciate it.
Thank you, Amy. Have a great day. Bye.
OmniTalk is released every other Monday. Since 2 weeks from today is Memorial Day, we will be releasing our next episode on Tuesday, May 26th. Thanks for listening. Stay safe and stay well.